Hey guys, welcome to the next video. Are you ready to purchase a home? So let's go through some things to think about as you get ready to purchase a home. Okay, um, here we go. So let's start with kind of asking ourselves these questions, right? And it's usually you want to start around the finances because we know you want to own a home. We know people want to own a home. It is a dream, right? But how do we get there? So we got to focus on finances first, right? So are you financially stable? Take a look at your savings and do you have about 3 to 6 months of living expenses? Okay, now this is going to be your emergency fund, right? And these are emergency funds put away, and it's not a part of what you should consider for your upfront cost of purchasing a home. This should be for after you close, any type of upgrades that you want to do or anything like that. Let's put all this in there, that 3 to 6 months extra living expenses. And it should be outside of things like your down payment, any inspections that you're going to do, appraisal fees, insurance costs, moving expenses, escrow, title, legal, and notary fees, right? And the lender is going to look at this too. They're going to want to, they require this. Depending on the loan that you have, right? If you're getting a jumbo loan, some jumbo loans are going to require up to a year's worth of cash reserves before they will lend you the money, right? Or that'll limit how much they will lend you. So things to think about for that, right? Do you have that extra set of funds put away just in case, right? And you should calculate kind of what your monthly expenses look like now, right? And this should determine how much you allocate towards your mortgage every month. Let's take into account your utilities that you're paying at your rental, things like that, food, car payments, any student debt that you have going on, fund money, kids activities, entertainment, that type of stuff. You want to have all of that in your budget. Will the lender use all of that for budgeting for you? No. But the difference with this being that a lender's going to look at all your income, and they're only going to take certain things into account, and that's going to be kind of what shows up on your credit score, which is, any payments that you have, any credit that you have out, that you have monthly recurring payments for. They're going to take that into account and start deducting that from your monthly income to come up with a number that they will lend you for your mortgage, right? So if you have $5,000 monthly coming in, but you have $2,500 of monthly expenses, you're probably not going to get a mortgage. You got to get all those expenses out of the way before the bank will give you a mortgage. Okay, but also take this into account. So the reason we want to look at all these costs is because the bank doesn't, right? The lender doesn't look at all these costs. So a lender might say, hey, you qualify for a $500,000 mortgage, but it's going to be, $2,500. This is just fake numbers, right? $2,500 a month in mortgage payment. And you're like, okay, I also have all these other expenses. So now I look at my total, what I'm spending every month, and I'm not comfortable with that. So what I am comfortable with is actually a $2,200 monthly payment. So what does that actually qualify for me for on the mortgage side, right? So take those numbers, talk to your lender about it, make sure you have all those, and that's just the difference, right? You want to know your expenses so you know where you're comfortable. You don't want to be house poor and be stuck in your house all the time and instead of enjoying life. So that's one thing you want to consider, that. Take all your expenses into account, right? And then here's the other thing, are you ready to take on the cost of becoming a homeowner? Is your income steady? Do you have a steady income, or does it fluctuate, right? Are you, some months bringing home $5,000, some months bringing $4,000, some months bringing $6,000? The lender is going to look at that. They want to know what your reliable income is and then go off of that, right? They usually want to see a work history of up to 2 years. Anything less than that, they can't really determine reliability, so they tend to like 2 years. And also they want to know if you're a W-2 employee. Do you own your own business? If you own your own business, there's going to be a lot more scrutiny. You have to take on the debts of your business. It gets a little gray there. So we totally recommend talking to the lender and working out those questions with them. Okay. And then can you devote time to regular home maintenance, right? As a homeowner, you're now responsible for any unexpected expenses related to repair and maintenance. You're not calling your landlord anymore. You don't have the rent. It's up to you, right? You got to have those people. You got to know those people, right? And then as an agent, I have a lot of those things, right? So if someone calls me, if we're helping somebody and they say, hey, this thing just happened with my electricity or my plumbing, I say, no problem. Don't worry about it. I got the right people to call. Give you the people to call, and it can get taken care of. But you got to be ready for those expenses. They're your responsibility now. Okay. And then how much would you be spending each month with home ownership expenses included to current financial situation, right? So take that into account. You want to put a little bit of your monthly away for some savings just in case something goes wrong, right? You never know on a house when something could go wrong. Things go wrong all the time. You just never know when that's going to be. Okay? Check your credit. Your credit is going to be important for this, right? So you've got your finances down. You know that you're comfortable buying a house now. You've worked out your expenses and you're ready to go. So the lender's going to pull your credit. Don't be afraid of the credit pull. It's okay. It's not going to hurt you. Even if you did it 10 times in 1 month, like the lenders will see that it comes up as a mortgage pull. So even if your credit score went down 1 or 2 points, whatever, they don't take that into effect because they know that your credit pulls are based on mortgages. Now, if you went mortgage, personal loan, car, all of those different credit pulls, that they're going to take that into account, and that's going to be negative on you, right? So let's do the right thing, do the smart thing. You don't need to go out and see 10 lenders. Just pick 2 or 3. Let them run your credit, give you some options, and go from there. Okay, because the credit score is important. It's going to dictate what type of loans, what your interest rate is, and all of that relates to how much what your monthly expense is going to be for the home. So credit score is super important, right? The credit score basically tells the lender how risky you are to lend money to. And the best way to have a good credit score is to make sure you're consistently paying off your bills and debts. Now, what do they take into account? So lenders these days prefer limiting housing expenses, right? That's your principal, interest, taxes, homeowners insurance. That's what you'll see on your monthly bill when your monthly mortgage comes to you. All of those things are included in the monthly mortgage. Okay. So that's how the government keeps up with their property taxes, all that stuff. It's in your mortgage, so they've already calculated for it, and so you don't have to worry about it. Now, when you first purchase your house, there will be often there's something that comes up that's it's called it's an additional tax, right? It's the difference in property tax that they messed up. So just be on the lookout for that comes up. But anyway, they want to stick to about 30% of your monthly income for your mortgage. Now, they will lend up to 49%, but usually that includes your other debts. If you don't have any other debts, they'll give you a 49% mortgage, up to 49% of your monthly income as a mortgage payment. So you make $5,000 a month, you'll get $2,500 essentially as your monthly payment to go towards your mortgage. Okay, so we're looking at monthly income minus the debts without the housing expense equals what your monthly housing budget will be, right? $10,000 minus $2,500 in bills, you have another $2,500, okay, to go for your mortgage. And then what is credit based on? Your credit is going to be based on your payment history, the amount of money you owe, the length of credit history. So how long have you had that card? How often have you paid it off? Or how often have you been leaving it there with a lot of money on it? All of that comes into consideration when determining your credit score, right? What type of credit have you used? Do you have a personal loan? Do you have a car loan? credit cards, like what type of credit are you using, um, and also, how often are you looking for new credit? Are you getting a new credit card every month? Are you getting a new loan every month? Something like that, or every 6 months? They take that into account, and that weighs on your credit score. Okay, and then ways to improve your credit score: pay your bills full and on time. Right, that's number one. Make sure you're getting all your bills and debts and paid on time. Right, stay within your credit card, your limits. You don't want to be if you have a $5,000 credit limit, you don't want to be maxing that out, calling up the credit card saying, "Hey, I need more room." That's going to negatively affect you. Okay, keep your balances as low as you possibly can. You want to, if you have $5,000 in credit, put $1,000 on there, pay it off. That's the fastest, best way to really increase your credit score pretty quickly, right? And then don't overextend by applying for a bunch of credit you can't manage. There's no point in having 10 credit cards, putting $1,000 on each one, and then trying to pay it off every month. That can become very difficult depending on what your income is, and that can just start weighing you down. So let's think about those things, okay? And that's it. That's our. Are you ready to purchase a home? Let's go on to the next one.